So let's talk about cost of goods sold. Now, cost of goods sold has multiple names, including cost of sales, COGS, or direct costs. It essentially reflects the costs incurred by a business to generate its revenue. Now, when you first bring your COGS information into your financial model via your accounting package, it comes into the historical income statement. Now, as you can see here, we have 3 lines of COGS being brought in, those 3 categories being Cocoa Bix, Just Wrong, and NutriBubble's cost of sales. And we have their historical COGS information on the right-hand side of the sheet here. Now, when we forecast COGS, that is also handled on the revenues and expenses sheet. So let's head back to our table of contents and activate that. Now, in the middle of the sheet here, you can see we have our 3 COGS categories being brought through, and they all again have their own unique drivers. Currently, these are set to percentage of revenue, unit costs and volumes, and year-on-year growth rates. Looking at our Cocoa Bix cost of sales forecast, you can see here that we are relating our Cocoa Bix cost of sales forecast to our Cocoa Bix sales forecasts. We're currently applying a 25% profit margin to our revenue forecasts. The reason that we create this interrelationship is so that as our revenue forecasts go up or down, our COGS, or cost of sales, also moves in line with this. If we look at December 22, for example, we're currently pulling through our 907.3 of revenue being forecast. If we increase our revenue for December 22 for Cocoa Bix sales to 1,000 by entering our forecast assumption here, you will also see that our associated cost of sales has increased too. Applying a profit margin takes our revenue and says 25% of this is profit, therefore 75% of that is cost, or the cost of those goods sold. A profit margin of 25 or a cost base of 75% of that revenue means that $750 is our cost of sales. When looking at cost of goods sold within a 3-way financial model, the 3 statement impacts are as follows. Cost of goods sold hits the income statement and the cash flow statement. The $75 of COGS flows down the income statement, decreasing net profit after tax, and therefore decreasing the total equity within the balance sheet. Cost of goods sold also hits the cash payments within the operating section of the cash flow statement, decreasing the change in cash held. The decrease in cash held flows through to the balance sheet by decreasing cash at bank, reducing total assets, and therefore balancing the balance sheet. In our example here of December 2022, if we want to see our $750 of cost of goods sold hitting the income statement, we can head back to our table of contents and load our financial statements. Expanding our cost of goods sold rows here, collapsed in row 28, if we scroll across until we get to December 22, then again we can also see here in December 22 our $750 of cost of goods sold hitting the income statement. Scrolling down to see the cash flow impacts as well, scrolling until we hit the cash flow statement and expanding our cash payment section, again we can see our cost of goods sold line item for Cocoa Bix, and therefore in December 22 we also have our $750 hitting the cash flow statement. In reality, there's always more considerations within a full 3-way financial model. For example, if we purchased $100 of stock within the business and 75% of that stock went out the door, then we need to account for the 25% remaining. If we are yet to pay our supplier for that inventory, then that would also increase our inventory payables. And if we had GST within our model, we would then need to apply GST to our inventory purchases as well. Now, each of these considerations will all be handled within their own unique videos. However, for the purposes of this video, when we're analysing the impacts of cost of goods sold within a 3-way financial model, we would expect to see cost of goods sold hitting the income statement and the cash flow statement, and therefore balancing the balance sheet.